Good evening. You're tuned into BQ Prime, and this is the fine print. And we are here to understand some of the decisions that has been taken by the GST Council, which was meeting after over 9 months in Chandigarh. The GST Council met for 2 straight days and took several important decisions. Of course, the highlight of this, in anticipation of this meeting, there were a lot of speculation around what will be on the agenda. And the highlight of that was the issue of compensation to states and whether or not there will be a decision to extend the period, which is ending on June 30th. The finance minister, in no uncertain terms and without divulging anything else, said the states have made representations, and that's it. That's all there is to report on this aspect at this point. But to understand some of the other decisions that the council has taken, I'm joined by Ritesh Kanodia of ELP and Badri Narayanan of Lakshmikumaran and Sridharan. Gentlemen, welcome to the fine print. There are quite a few key decisions in terms of rate rationalization that have come out, and the FM said that it's to fix the inverted duty structures. There is some decisions for e-commerce platform suppliers that has come in. A lot of speculation was also around, or industry was expecting some clarity on some of the GST issues for casinos and online gaming. The FM, in no uncertain terms, again has said that look, it is all gambling, it's all 28%, but some of the valuation concerns was something that we were hoping some clarity on, but that for now has been deferred. From what I remember correctly, the GOM is going to submit its report by the end of this month, and which will be taken up either on 1st August or the first week of August, when the GST Council is slated to meet next. Let me come to you, Badri, first to try and understand the impact of some of the rate rationalization moves on both goods and services. But before I give you the floor, there was a raging debate in BQ Prime's newsroom on what is Pavan Chakki, that is air-based atta chakki. If you could first clarify that for us.
No, I think so. There is one aspect which is it's a very interesting, very how it is. So there is some issues.
Actually, not Pavan atta chakki, haven't I?
Yeah, so I think one of the things which is when big important changes come in is that branded food items, okay, are being are being brought into the net if they are complying with the Legal Metrology Act. So just to give you a sense, there used to be a big dispute regarding if you went and got atta from your local atta wala, and if you put a stamp Pavan Atta wala on top of that, the department used to say it's a branded atta and therefore you pay tax on it. While if I put it normally and give it to you, he will say there is no tax at all because it is unbranded atta. So there used to be a big rate difference between branded atta and non-branded atta. What used to happen because of that is that a lot of the people transferred their IP from that company to another company to make it unbranded, though it is in a packaged commodity. Now they've kind of taken it off and said all food products which are going to be in packaged form are going to be at the same rate of tax. So if it is packaged, it will be that. So they're going to move away from branded and unbranded to packaged and non-packaged now. So, but it'll be an interesting thing to see.
Branding going away when this distinction had come about, we would just see transparent packets without any branding, right?
Exactly.
Which have some branding. I guess that sort of arbitrage now has gone away.
Exactly. So what people used to do is that the big dispute used to be ki, like plain paper mein aapka aa raha hai without any brand, there used to be an exemption available. But there used to be a big problem because there used to be normal people who used to put just their name on top of it, more as a reference than for anything else. But it didn't have any real brand value. While then you had other products like basmati rice companies and all which have built a brand who also wanted to take advantage of it. So there used to be a big dispute. And there's been a lot of restructuring in the business, the food business around this. I think they put an end to that by saying that we don't care whether it's branded or unbranded. If you're complying with legal metrology laws, okay, that is a pre-packaged commodity, okay, then you are required to pay tax. So that dispute is gone. but we may have other disputes around it.
Yeah, very quickly, I'm not going to read out this laundry list that has come out by way of a press release, Badri, but when they say rate rationalization to remove inverted duty structure, can you sort of translate the implications of this? Because most of the
Sure.
rates have gone up, let's say from 12% to 18% for printing, writing, or drawing ink, or, for edible oils and prepared, unfinished leather, goods, etc. This is not going to lead to, and the revenue secretary also alluded to it, a massive sort of jump in revenue as such, but this is just fixing an anomaly. Can you just elaborate on that a little?
So Payasini, we used to have a problem of inverted duty structure. Okay, what used to happen is that when we moved from our previous regime, which is excise and sales tax and VAT, to the GST regime, we tried to map our rate similar to what was there earlier. We used to have problems in excise regime as also in VAT regime relating to inverted duty structures. What that means is that my input, which were used for the manufacture of these goods, had higher rate of GST applied on it when I received it. And when I manufactured and sold the new product, it had lower rate of GST. Now, if you had small percentage of difference between the rate of input and output, and you had a large value addition, that will get consumed off. But if the rate difference was high, say for example 6% between 12 and 18 or 5 and 12, and the value addition was smaller because you're getting all these inputs, you're putting it together and selling it off, then you're not able to exhaust the credit, and that becomes a cost. Okay. Now the credit, as you know, is not something which is included as part of the cost of the goods, and it is retained for its use in the future. But it becomes a cash flow issue. It also becomes an issue where some auditors will say after 5 years that you must write off this credit because there is no chance. It's accumulating year on year. So now what the government, there's been a lot of representations from the industry on this, saying that we need to rationalize these rates. These rates have to change. Please increase the rate or reduce the rate on inputs. So what the government has done is kind of gone with the fact that they've increased these rates. So like you said, the rates have increased. So optically, it looks like there's going to be more taxes. But I believe that there's a lot of accumulation of credit which will get used. And even if it is not, it's not likely that we're going to get much value in terms of tax out of this, because the inputs have already suffered a large amount of tax. And we are really going to see very small deltas of tax collection increase. My own sense is the next couple of years, there'll be no outflow of taxes on account of this change, but the industry will be happy because the books will get cleaned up.
Yeah. So Ritesh, this accumulated credit, because the rate change is going to happen now. How will this sort of play out for businesses who have these accumulated credits on as a result of this inverted duty structure?
So, Payasmi, what would happen is that you would start charging a higher rate. Once this rate changes come into effect, and when you start charging higher rates, there are two ways of making payment. Either you would have paid it in cash, or you would pay by utilizing credit. So when you talk about accumulated credit, doesn't mean that the credit goes off your book. It's still there. So a major portion of this tax payment would now be through the past credits, and going forward, because of the rate rationalization, the rate increase, your credits would not get accumulated. So this is how the idea is to sort of improve this entire credit flow. The only one issue which I see is places where credits are not available on the output. There, the increase in the rate, like for example, in the case of solar, where the output is exempt, the rate increase will definitely go and hit the bottom line because it's not available to the end user. Another places where you need to have reversals of credit because of some exemption. So while I agree to Badri on the fact that this may not have substantial impact, but again, we'll have to just see industry to industry in terms of how it affects them. But yeah, majorly the idea is a pass through.
Yeah. And also then, I mean, the credits, like you mentioned, accumulated on the books of these industries will get utilized towards this increase in rate. There's also, similar rate rationalization has also come for some of the services. I'm not going into that. The second big sort of outcome is withdrawal of exemptions, Badri. What has prompted this? Because, I can see things like, if you are paying a room rent in a hospital for more than 5,000 rupees, so far it was exempt, but now you will be charged at 5% without input tax credit. Similarly, a lot of other services, whether it's transport of passengers by air to some specific locations, then there are, small things of checks, loose or in book form. Those kind of goods now, which were in nil, have now come to 18%. Can you make sense of what has prompted the withdrawal of exemptions from some of the goods and services?
Some yes, some no. We'll have to just think through some of that. So let's say, for example, you take the hospital case. I'm a bit surprised by this exemption being going away and imposing 5% tax, because there's no input tax credit available on this. This seems to be just to tax the rich rather than anything else. So those who can afford to pay 1,000 rupees for a bed should also be able to pay 50 rupees for the GST on that. I can't see of any other reason for it, because there's no credit being made available. Hospitals tend to have some accumulation of credit, but not a lot of it, because as you know, medicines are exempt, or at least on lower rates, and also your services, typically healthcare services, tend to be on the lower level. But I don't know the rationalization for this. It will be an increased compliance burden for the hospitals, according to me. That's going to be one. Hotel, again, they've increased for 1,000 rupees or more. They've made it 12% with credit, again making it a little bit more expensive. But that could be for kind of whatever accumulation they may have had in the past. I do not know. So this is again a rationalization which is there. Some of these are just policy rationalizations. Okay. Some of them, for example, printing 5% being put for the purpose of being able to do that, maybe just to kind of track people. So what is being what's going in the economy, who's manufacturing this. Sometimes you put taxes of about 5%, not necessarily to collect taxes, but to track the transactions that are happening in the economy. So I think some of that is that. Some of the other things which I think they are kind of adding to, if, for example, like this cordbud blank, they have kind of imposed tax, okay, on preservation of stem cells. I do not know the rationale for it. We always thought it's something which is in relation to healthcare services. So that's a specific exemption which has been withdrawn. There are some other exemptions which are of that nature, which are being either withdrawn or rationalized. I think some of this is just to track, and some of this is just to kind of see from a data perspective what is going on. Some of it is just odd, and some of it is really just to kind of be able to reach the tax. So, so that's really what my impressions of this are.
Ritesh, any quick comments on withdrawal of exemptions from some of the goods and services?
Ayushmani would sort of basket this into one or two, three things. So one is simplicity, where the exemptions would have outlived its utility. So sort of creating, let's take storage and warehousing, which attracts tax. So now, obviously, when the commodities attract tax, there is a flow through of credits. So it doesn't make any sense to keep that exemption alive. Like residential dwellings to business persons can take the credit. So there was no rational or logic to keep them exempt. And generally, what used to happen was there were certain structurings, like guest house, for example, is one typical example where there was always a debate on credit. If, let's say, guest house has been rented out to business use, etc., credits were lost and businesses were not getting credit because there was no output. Also, some of these are actually beneficial, like biomedical waste. So there are government contracts where if you do biomedical waste services, the biomedical waste services are exempt, right? Now, what used to happen was all the credit which all these contractors used to take, these are private contractors appointed by the government, was becoming a loss. And there was a huge debate around whether a subcontractor will also get covered under the exemption, etc., because they will generally hire subcontractors. This actually opens up this entire fungibility of credit, because now you can simply set a charge to the government, recover, and you can take all your credits. This would add to their bottom line. Again, hotel accommodation priced up to rupees 1,000 per day. I don't know. So they've already specified different rates for different slabs, etc. Maybe this was to expand the tax base to beyond 1,000, because below 1,000 was exempt. Hospital, I think, is a big impact from. But what is happening today is that hospitals all the rooms are exempt. Now, typically, an end user doesn't pay for those rooms. It is being borne by insurance companies. So now what will happen is all this GST cost will get passed on to the insurance companies. And there is already a debate whether an insurance company can take credit of this GST charged by, let's say, a motor car insurance. So this would be an interesting space to watch. Clearly, it will increase the cost, but we need to see for whom. So this may have a counter effect on insurance policies, where if you go and take an insurance policy, it is a particular price, may lead to even an announcement of that price if the credits are being denied. So clearly, a lot of implications.
Okay, this is helpful. I'm sure. I mean, now even services by regulators, the exemption of that has been. Okay.
RBI will.
Yeah.
So RBI and SEBI will also impose taxes on this. Yeah.
Sorry, Badri, you wanted to say something.
No, it will be interesting to see how they will levy on forward charge some of these for services. What are they actually going to be levying? So there have always been some issues with respect to the services, whether they've been provided or they are statutory in nature. What is it? So it'll be interesting to see how and what the position will be taking.
In SEBI is providing services to whom? I mean, what are they going to start raising invoices on?
So I don't know. So for their application forms, for their various other services that they're going to be providing, okay, wherever you need to pay a fee, there'll probably be a GST component attached to it.
To pay a fee to SEBI, those services now will sort of, regulatory services will now attract GST. Okay. There's
I just wanted to add Payasmani over here that services provided by the government, the debate and the dispute was who is government, who is not government, and these are under, most of these government services are under reverse charge. Maybe this now brings in clarity that all this registration fee, because ROC fees, for example, the issue was whether GST is applicable or not applicable under reverse charge, because corporates have to bear that tax. And so I think the intent seems to be that now sort of bringing it very clear that all the fees, registration fees, etc., paid now become liable, and you pay under reverse charge and take credit.
Okay, all right. I can also see some sort of rate clarity for some of the items. Like, for instance, they've said electric vehicles, whether or not fitted with a battery pack, are eligible for a concessional rate of 5%. I mean, I'm just wondering, could you spot any unusual items of clarification here? Because I would imagine these would be industry asks that I'm guessing the GOM has sort of represented in their report and have been now accepted by the council.
So I can personally see a few things. So electric vehicles was a dispute where the issue was raised is that if you supply electric vehicle without battery, because battery is a very critical component of an electric vehicle. Yeah. And the issue was raised was if it is without battery, it doesn't remain an electric vehicle, and therefore GST. So this is a welcome clarification. Flash was again a previous clarification which was issued where they had specified a percentage of ash content, and the dispute was that they've said 90% and above, and the argument was that all these flash bricks are made through various methodologies, so 90% is an unreasonable ask. That is what they have now clarified. I would just add one more interesting point is the transportation. So this entire issue on transportation of
renting or hiring.
Renting or hiring.
Hiring. That is. So
the dispute was.
Please go ahead. Please go ahead.
No, go ahead, Ritesh. On renting and hiring, there used to be a big problem whether it should be at 5% or at 18%. Okay. There always used to be a question, what is the category in which we are going to be doing the transportation? Now they've clarified it, and they brought it 12% if I'm not wrong, right?
Yeah, 18% and 12% with fuel.
With fuel.
So
similarly, so that used to be there. Then other areas of investigation which have been happening, this orthodontic appliances, then some of the issues relating to like splints and other fracture appliances, other things. There used to be, then IVF, there used to be an investigation. Okay. So there used to be, some of these are investigations where the assessee has gone and told the department that there is a problem with the way the department is. So for example, the renting and hiring used to be a cause of investigation. Okay. So the department used to keep trying to take one rate and apply another rate, and there used to be denial, just like electric vehicles, all of these things. So all of these have been brought into place to reduce and kind of let go of the investigation where the department felt that those are not to be undertaken.
All right. So I'm bucketing this under clarifications which, eventually will probably reduce litigation, on some of these aspects. The third key issue that, got resolved in this is for suppliers, to e-commerce platform who've now been allowed to operate under the composition scheme. In fact, there was a parliamentary committee report a few weeks ago that had pointed out this issue that has meant that, because there's the difference between online and offline players, it's sort of hurting a certain sector. And now they have seemed to have got both, let's say buckets on a par. Ritesh, what do you see as the immediate sort of impact of this?
No, so Pasman, this was anyways industry asked for a long time. So there are two amendments if you see. So one is mandatory registration, which has been waived off. Now, what used to happen was there was a requirement that anybody who supplies to an e-commerce operator has to register. This was per se contradictory, because if I am not under GST net, how would somebody deduct TCS? Right? So there was a deeming interpretation was being made that now you need to register and TCS will also have to be deducted. So let's say if service provided to e-commerce operator was exempt, I need not register. So why do I need to register only if I'm through e-commerce operator? And then there was an interpretation issue around TCS. So this contradictory provision has been removed, where it is so basically it means that if you are not registered or if you're not exempt, for example, TCS will not be applicable. Makes it very clear. Second was, of course, this entire issue of composition, where in terms of increasing their business, because if they would have supplied through today, e-commerce supplies are a trend, right? If I have to order anything, I just go on an app and order. Now, because of even if a single supply was made through an e-commerce operator, it would have disentangled them to benefit of composition scheme, which was not justified. And so therefore, now this limitation has also been removed. So when they supply through all this player, now when they supply through e-commerce operator, like a local breadwala supplying through, let's say, Dunzo or somebody, now they can very well still go under a composition scheme for all the supplies. So again, a very, very positive. Only limitation they've kept is interstate, and generally all these small-time guys would not do interstate supplies.
Because this would be sort of local MSMEs in that sense who would
like your Swiggy, Zomato, Denzo, all these apps which are now sort of catering to your needs, local needs, etc. So the names, and I'm talking about the shopkeepers who would be entitled to composition scheme, not the e-commerce operators. They're just the intermediaries.
Badri?
Yeah, I think I agree with that. So the key thing is that many of these people were already under composition scheme. Okay, so I used to have situations where shopkeepers, especially when they are, let's say, based on agri products. Okay, so they would be required to take registration mandatorily, regardless of whether the product is covered, not covered. What is it? That is one aspect, one problematic aspect that used to be there. A lot of agri-tech startups had problems with this kind of an issue with respect to that. The second, like Ritesh said, if you are otherwise eligible for composition scheme, you should not be having to pay full tax when it is there. And as you know, earlier we had seen that by having a composition scheme, you're able to make a little bit of a margin on the retail sale price. Okay, because something which is at 18% finally, which needs to be paid. Okay, if you're on the composition scheme, you end up paying a lower amount of tax on your outputs. Okay, and because of which you're able to claw back some of that, even though the RSP or the product will continue to be there. So that gain used to be lost by some of these people. So there used to be a lot of, this is more of an encouragement for you to do more business on the e-commerce platform. I think that's really where we are going to see some of this.
3,000, right? If I remember it correctly, Badri?
40 lakhs, 20 lakhs and 40 lakhs.
Yeah, 40 lakhs and 20 lakhs.
Interstate and intrastate.
Okay, all right. But this will, of course, be for interstate taxable supply, because
this will be, this is, I think, really like what he said. Intrastate is what is going to be covered in this.
All right. Okay. Final question then. I mean, there are a lot of other clauses that have come to, be clarified by the GST Council. And of course, we'll need to see the impact of some of those as we look at those sections. But one thing, Badri, that you've been sort of working with one industry very closely is this online gaming, where, like I said in the beginning, the GOM is yet to make up its mind about the suggestions that it will make. In the interim, could you outline some of the issues that we could see clarity on, once the GOM submits its report?
So first thing I think is that there is a lot of consensus that the rate is going to go from 18 to 28%. I think that's going to be, you also mentioned that at the start, it's probably going to go to that rate. The big question is what's the value on which we are going to be paying the tax? So the industries ask is that GGR, which is a gross gaming revenue, which is the platform fee, should be the value on which the tax should be imposed. There was some suggestion that there could be a deemed rate of 15%, 20% on this, on which you'll have to pay 28%. So that's one leg of the story. The other leg of the story is that if you take casinos, horse racing, lottery, and others, okay, they are having to pay tax on the entire ticket value. So when you go and buy a lottery ticket, you buy on the entire 100 rupees, you pay 28%. Okay. So the question then comes is that similar industries where staking is involved, on one industry, you are taking on GGR and paying tax. On other industry, you are taking 28 on the full value. Okay. So the real valuation dispute between the states is whether it should be on GMV, which is gross gaming value, gross value on which you have to pay the tax, that is the ticket value, or it should be on the platform fee, which is the GGR. Okay, so that's where it's been parked right now. I think it's gone back. There's a lot of divergence of views within the GOM also on this. So some feel that it should be on the platform fee, which is truly the fee that you earn from these in this area, or it should be on the full value, which some others say, based not on this, but on the justification for lottery operators and others. So that's where the dispute currently stands. And that's what's been referred back. So you'll have to come back with, I think, a compromise on what will be the value on which they will pay the tax. I think the government is keen on promoting the gaming industry because it sees as an industry which is going to give employment and other things, while the states probably see as something which they want to be at par with more traditional operators. That's the area which I think is really on the anvil on this.
Okay. One quick another decision that I can mention is the states have been allowed issue e-way bills or introduce e-way bills for precious stones like gold. I think that ask was from Kerala. It has been accepted by the council.
Sure.
So they will of course come up with what details need to be on those e-way bills for security reasons. But that announcement has also come through. Gentlemen, I think we've done the initial assessment, Ritesh, unless you have something to add in terms of when Badri and I were chatting, if you were able to spot any gems in this 5-page press release.
So there are, in fact, we've not discussed the core issues at all. Let me put it this way. I'll tell you why. So 89.5, Badri would know VKC for steps, which is the Supreme Court judgment, which has pointed out an issue with the formula, right? Yeah. That has been addressed. It's a big thing because this was the demand of
what the sort of change here is?
So the issue was that, so one ask was that the input services which are there, right, they should be eligible for a refund. That ask was sort of set aside by the Supreme Court in terms of interpretation of law to say that input credit does not include input services. But then there was a distortion in the formula in terms of numerator and denominator, because your output had both goods and services and your input had both goods and services, because of which my credit percentage, refund percentage was reduced substantially.
Yeah.
Now this is big because this will have a huge impact on all the refund applications, which is very positive. We just need to see the formula.
Refund will include both for goods and services. That's the clarification.
No. The refund will include only for goods, but the manner in which the formula will now be calculated would balance out the numerator and the denominator. So consequentially, your refund percentage will increase.
Got it.
Which was also an observation in VKC footsteps to say that you need to look at the formula. Another very important issue is let's say for example, when you talk about inverted duty structure refund, what does it mean? So let's say you have a 12% rate, but there is a concessional rate of 5%, 18 concessional rate of 5, notification, exemption notification. And the question was whether that concessional exemption notification would be considered for inverted duty structure refund. Was the intent? So if schedule rate is 5, that's okay, you get a refund. But what if there is a notification and the rate is reduced to 5? Now, what is the clarification? We don't know, but what it is written is it has been clarified. Third is the retrospective amendment has finally come on the interest issue. So section 53, interest taken but not utilized. And then there is also mentioned that they've given the manner of calculation. So we'll have to now see the manner of calculation to figure out, what more litigation would arise in the manner of calculation.
Yeah, some of these things I didn't bring up, Ritesh, because the left it at circular will be issued. It will be clarified.
No, but I know. I'm just highlighting the criticality of this clarification.
You're spotting these for us.
No, I'm just highlighting the criticality. And so, for example, this clarification on interpretation of section 17.5. 17.5 is, this credit restrictions.
Not available.
Yeah, and a lot of interpretation on.
The two of you, you've agreed what 17.5 is. I don't know what 17.5 is.
Okay. No, so 17.5 basically talks about credits which are not available. It's a restriction. So, for example, construction-related credits, right? Or, for example, employee-related personal consumption. These are specific provisions where credit is not allowed. And there is a huge issue in terms of interpretation of 17.5. So there are different line items, and on each of these line items, there would be one or the other issue. So obviously,
but Ritesh will have to wait for the law on that.
No, agree. No, but what I'm just trying to highlight is that.
So we are going to see. So what Ritesh is saying is that you need to call us again at some point of time when the law comes to that. But I only want to add one last thing. I think Ritesh is like one of the big asks, not necessarily from the industry, but also from our professionals, is that we need to relook at the GST tribunal, appellate tribunal.
Yeah.
And, we've gone to court saying that constitutionally that is not correct because, having two technical members and one judicial member kind of renders that a non-est kind of a thing. And constitutionally that will be considered to be proper. And that there has been now been referred to a GOM, which is to give a report considering all of these issues to be able to see what should be there. I think that will be very, very important. And I think setting the GST tribunal is going to be the next big thing because once that is set up, there are already so many appeals, so many matters which are now going to High Court directly because the tribunal is not there. I think that's going to be the big next step, I think, which is going to come out of this. We'll see how that plays out and what their recommendations will be going forward.
No, absolutely. And I have no absolute qualms of calling you guys over and over again for the benefit of our viewers who want to know more about the specifics of the decisions taken by the council today. And we'll, of course, be on top of it here at BQ Prime as and when those specific circulars come out. Badri, Ritesh, thank you very much for spending time with us and taking us through some of the important highlights and the whys of some of the decisions that have come in today's GST Council. We'll come to you next as we get more details. Thank you so much for joining us here on BQ Prime, and thank you so much for watching.
Thank you.
Thank you so much.